Welcome back, everybody, to the Stock Market Brief Show. We got a wild episode up ahead. In today's video, we're going to be tackling the crucial topic, the impact of a quote-unquote mild recession on the stock market. We're going to be deep diving into the CPI data, small business confidence, banks tightening their credit, and we'll also be discussing key turning points in the market using technical analysis, overlooking the major indices such as SPY, NASDAQ 100. We're also going to look in the financial sector, and then we're going to examine some of the mega cap stocks, Apple, Nvidia, Amazon, and Microsoft. So we got a lot to discuss. Buckle up, get ready, let's get into it. Welcome back, everybody. So take a look at this. We got that inflation data come out, and that happened to be during the pre-market right over here, and the market took off like a wild bucking bronco. Now, if you take a look where that came to, this is why I say these expected moves are so important to watch and pay attention to. In the pre-market session, it came up to where that 413.69, which we discussed on the prior video. We'll give you the updated numbers more towards the end of this video, but CPI came out and then it started fading throughout the day. This isn't a fully updated chart. We'll get there. So what came out overall with the inflation data? Well, the year over year was down. Well, it was down here. It's kind of a tale of, well, two stories, because this inflation rate was down. However, the core went up, right? It met consensus at 5.6. That was the actual print, but it was up from the prior month. Now, another interesting stat that came out just recently was the United States Business Optimism Index. And if you take a look at this, it's not looking all too hot. Now, you might be thinking, well, what is this and why is it important? This is a composite of 10 seasonally adjusted components calculated based on the answers of around 622 NFIB members. Now, the questions include plans to increase employment, plans to make capital outlays, plans to increase inventories, and so forth down the list. It gets a good gauge on the overall market. And if we zoom out back to the 1980s, 1970s, you can see that, we know about the great financial crisis and we know about the 1980s. And what we see taking place here is a pretty similar rate of change drop here within this survey. Now, if I pull this open, one thing to call out on here, one of the big ones, and a couple of them, is it marks its 15th straight month the index is below its 49-year average. So that's pretty wild to see 15 straight months below its 49-year average. And this is basically telling us small business owners are cynical about the future economic conditions. And if you look at the bottom here, it says small business owners expecting better business conditions over the next 6 months remain at a net negative 47%. So small business is incredibly important, especially to the economics of the United States. And as you can see here, it's not looking all too hot. Business owners are lacking that confidence. But don't worry, back in October, Janet Yellen was saying what? She does not see signs of a recession. And more recently, she says that the economy looks bright. When she was asked about that forecast, Yellen, an economist at the former Federal Reserve chair, she was a former Fed chair, countered that the outlook is reasonably bright. She cited diminished inflation projections, easing commodity prices and supply chain snarls, and an international financial system that she said has proven resilient. And if you take a look over here at this chart, this is looking at loans and leases and bank credit, all commercial banks, so credit growth, and we're looking from a year-over-year perspective. And one thing that's interesting to call out on this chart is every recession, you can see the gray shaded areas. Right before that, you typically saw a slowdown in the rate of change in credit growth. And I want to pull up the chart here in 2000, which was the dot-com bust, the 2008 financial crisis, and where we stand currently right now. As we're now talking about a potential mild recession, you can see that we're starting to make that turn here on this chart. And you could see the last time we did it, and that led to some pretty significant sell-offs in the Wilshire 5000, which is a more broader market. Now, what can be a catalyst to see potential more damage done? We all know the debt ceiling's coming out, and that is going to be between July and September 2023. We talked about that in this specific video where I highlighted a chart of credit default swaps. This is the 5-year USD. And back in 2011, when we led up into the time where the credit ceiling debate, and we saw a rise in credit default swaps, the market had fallen around 20% within a very short period of time. And what you're starting to see right now is a pretty similar situation where we're seeing a rise in these CDSs, and we're coming into a potential catalyst where we can see more market turbulence. But don't worry, this is just a mild recession, okay? Oh wait, no, this was in 2008 that this came out, that he posted. So it's likely to see, yep, some more sad faces on CNBC as we've seen in the past during market turmoil. Now, what else do we got going on? We have earnings coming up, people, so be careful, right? We have more volatility here. In earnings season so far, it's not off to the greatest start. I think we've had about 17 out of the 500 companies in the S&P 500 report, and it's not looking all too great, and this is going to last for another month. Okay, now the big ones are going to start here at the end of the week, so we have days to that. It's going to be Friday where we have the big banks reporting earnings. And if I show you these banks, we'll take XLF as the proxy, which is the financial sector spider. I mean, it's not looking all too hot. We're getting some relief, but guess what? This could just be a big bear flag structure where we had a big move, big break, and big volume. All right, now we're kind of just doodling around, floating upwards into earnings season. So this doesn't mean it's going to break, but we at least have to look at a longer term chart to see what may happen if it does. And if it were to break, where can we potentially see financials go to? Now, I want to call out that the financial sector, it is actually trading above its pre-COVID high. That was COVID, and then we started moving higher, okay? So we're starting to get some more volatility now, but I want to call out this 200 weekly moving average as it held as support, and then we came down to it, but the only way we broke through it was by gapping straight down. It held as resistance, and then guess what? We got back above it through a massive gap and go, and you can see that it just took off, never looked back. So if this bear flag breaks down, a measured move would bring us to around 26, and you never know. We might be looking to potentially fill this gap if more instability or this recession is not as mild as they say. Is it possible to fall further? Absolutely, but this would be a level to pay very close attention to in the future if we started seeing some very violent moves to the downside in financials. Now, you got to note, it's very hard for the S&P 500 to perform strongly when you see big hits to financials. Financials right now, as it stands, is it's in the top 4 sector in the S&P 500 out of the 11. The top 1 right here is information tech, right? And if I take a look at that and I look at the top 10 holdings or so, you can see that the big dogs are Apple, Microsoft, Amazon, Nvidia, and Google, and so forth down the list. But the big ones here, like I said, the top 4 names that make up for pretty much the biggest weight here in the S&P 500 is Apple, Microsoft, Amazon, Nvidia. So I want to show you what do those charts look like, and what would happen really to the S&P 500 if these start to take a back seat and financial also get hit. That is a recipe for disaster, in my opinion, for the S&P 500. So what do we look at? We're going to take a look at the weekly charts here of Apple and the other ones. So if I look at Apple, you can see it's coming into a prior area, prior trend line that acted as prior resistance. You can see we pushed off of it once, pushed off of it twice, pushed off of it thrice. And then you can see right here, we're starting to push off it again. So to be more bullish, you'd want to see price get through that level to be much more confident. But as it stands, look at 2023. 2023 has been basically a straight move up. So this is going to have to consolidate. It could very well pull back, but that means that one of the biggest names in the S&P 500 is going to be taking somewhat of a back seat, or the possibility of it looks potentially likely. Now, if you take a look at Microsoft, it has also been doing great for 2023, but we are coming into a prior area that we pushed price off before. You can see we actually gapped through this area. Boom, we try to come back up, multiple wicks right there, 3 weeks in a row. We push back down. And now you can see we had this nice move in 2023. This could very well be potentially kind of a wedge forming over here. And we're starting to push off of that. So what you'd want to see is it to break through these levels or potentially pull back, which can, add more volatility into the S&P 500, and then eventually break it, which would create somewhat of a inverse head and shoulders type pattern there in Microsoft. And if I take a look at Amazon, it's looking to break this downsloping trend line. You can see it's been holding. It's a pretty steep decline. And then we're kind of somewhat flagging over here, as you can see. So if we start breaking down through this 80, which is held as prior support, it's held as prior support here, through here too as well. That would be positive if it can hold, but if it starts breaking down, you're talking one of the top 3 dogs in the S&P 500 gets more pain to the downside. And then on top of that, we have Nvidia, which has been on a just monster run, seeing multiple weeks straight up, and that is here in 2023. These type of moves, it doesn't just last like this forever. We can see explosive moves. This was huge, right? 140 up to like 280. So a gigantic move. And what we could see here is we broke this downsloping trend line. Okay. And now what we're seeing is actually price, right? Price is tightening up. It was expanded and now it's coiling up into where? It's coiling into this prior area that we pushed off from before, and it acted as support, kind of, distribution up in this area. So if the RSI starts curling back down, if the MACD starts turning back around, we could potentially see price, right, start to pull back to consolidate. Doesn't mean it's going to crash like this, but if it were to crash like this, and these other names that we talked about get hit, you got to understand that the top 10 holdings or the top 4 holdings we just discussed make up a large portion of the S&P 500. And as I priorly discussed, right, we have financials reporting earnings. And if those are not good, that is not a good sign for the S&P 500. So you got to be just aware of this, right? Don't take a back seat to all of this. There's clear risks taking place. Now, if I take a look at the BP SPX chart, the RSI is moving into that overbought territory. Remember, it recycles. It oscillates between overbought, oversold, overbought, oversold. It's going to be oversold in some day, here again, but it can remain overbought for some time, and it can remain oversold for some time too. So continue to watch that. If we take a look at the daily chart of the S&P 500, you can see here, we're just in what's called, this, I would consider this just a bullish consolidation, but there are some negative signs showing up on a couple candles. This one and this one, where we had gap ups and they close more towards the low of day. Bearish piercing pattern. This is a bearish engulfing pattern right here. So, and this bearish engulfing came on a little bit stronger volume, but overall, we're just going sideways. This sideways action could represent later down the road potential distribution, and then we'll notice that in hindsight. I would say pay close attention to this trend line right here, right? As we've been pointing out in other episodes, it's kind of been in this, tight, algorithmic type channel. And if that starts breaking, we can go test that 50-day moving average and potentially even lower back to the 200-day moving average. Overall, when I look at this, and if I don't call out the bearish engulfings and the volume, right, we're just coming right back up to this prior high. So if we just consolidate and put a handle out maybe, and consolidate and move back up, this would actually look pretty strong if that's the case and we start breaking up higher. So that's always a possibility too. Remember, all these trends right now, they were super bearish, and now if you look at the moving averages, they're starting to kind of become spaghetti, which means what? It means a neutral trend, and you can see that right here. We haven't moved anywhere for like 7 trading days, right? 1, 2, 3, 4, 5, 6, 7, 8. So 7 or 8 trading days, we haven't moved anywhere. It's been crazy chop. Could be consolidation, which is bullish, but we just got to be aware. You'd want to see price get back above this high to be a little bit more bullish. Let's hop into the 15-minute time frame. So we already discussed that the pre-market session hit the daily expected move. So going into tomorrow, the daily expected move to the upside, 411.02. Daily expected move to the downside, 405.08. The orange lines, those are the weekly expected moves. If you don't know what those are, I have a link in the description that explains what expected moves are and how you can use them. But just in short, 68% of the time, right? And even higher with the S&P 500 or the SPX, it closes within the daily range, and you can create trades, on the edges of them or play into them. There's a bunch of different techniques. People that I know sell premium, on expected moves on the weeklies, potentially the dailies. As it stands right now, what am I seeing? Well, we're in a chop box. We're just in this volatility, chopping range taking place here in the S&P 500. You're starting to see the 5-day moving average start to neutralize. We're below the 5-day moving average. We're below month-to-date and week-to-date anchored VWAPs, which is not a good sign overall. This means that it opens the door for what? The lower weekly expected move. If I go back to last week, we did not touch the weekly expected move, and that's pretty rare to see take place multiple weeks in a row. So with the financial earnings taking place, with the PPI tomorrow, I think that we're still going to be tagging one of these weekly expected moves. To be bullish, I'd want to see price back above this area, which tomorrow that would be right by the daily expected move. So, it's a little hard to kind of gauge a good trade right here. But if we cannot reclaim these 5-day, week-to-date, month-to-date, and we start, flagging up into these areas, I think that opens the door for the lower daily and potentially even the lower weekly expected move. But like I said, Who knows what earnings are going to do? Who knows what Jamie Dimon's going to say, or whoever's reporting? Who is reporting earnings again? Let me go back to that slide. Jamie Dimon, JPM, right? That's going to be a big one to watch. Let's look at the Qs really quick. The Qs started the day popping up a little bit higher, which is a positive note, but it was just a lot of volatility. And as we stated, right, if we get this sell-off, look for a potential pullback or flag into the 5-day moving average, week to date and month to date, and see if that holds as a level of resistance and starts to push away. So as this stands, this looks weaker than the other index product, the SPY. This opens the door to the lower weekly expected move. Remember, we've already kind of sold off quite a bit. We may see, who knows, we might just start the day here and then we might come back up to fill the gap. That's a possibility. I would not, if we gap down here, I'm not going to look to short in the hole like that at all. But if we start moving up to the upper daily expected move, look where that is. That's still below the 5-day moving average. Price would be there month to date and week to date turning up. So that could be a potential opportunity there where, hey, if we get some rip run like this, like we had here and here, hey, maybe that might open the door to sell into some of that strength when it starts to weaken, to see if we can start heading back down into that lower expected move. Two more things that I want to go over. BookMap. BookMap's daily expected move is up here at 41.45. This is for ES, for the ES traders, and then the lower is just above 40.80. Now, yesterday we discussed the 4,100 level. You can see that's still highlighted there with some contracts. That price breaks from that level, and then it gets sucked right back in. So we've been just right at that 4,100. If you are trading tomorrow, pay close attention to 4,100 if we start breaking down from that level, and pay attention by what I mean is the volume. If we start breaking down from 4,100 and pushing away, you will notice volume start to increase. This has been a very key level in trade. So as we're pulling back into it, watch for upticks in volume for a more significant potential type move or potential trade to trend outside or push from those levels. Other than that, if you don't know what BookMap is, BookMap allows you to see the order book, like level 2 data. It highlights it on the screen. Just amazing stuff that that team does. They offer my subscribers a discount. The last thing I want to close off with is the zones. This is something that I share with my Patreon group. If you want to see about that, that's just on the pinned comment below. But I just wanted to call out that the dollar is getting into the green. And remember, we talked about the negative correlation between the dollar and like the S&P 500 on other days. And this is just, today the dollar was down and the S&P 500 was down. But if the dollar starts moving up, perhaps that correlation does come back, that negative correlation. And then all of a sudden, the S&P 500 can break potentially the midpoint, right? We're still above the midpoint, 40.91, midpoint's at 40.85. If we get a significant hit below that and the dollar starts moving up higher, that could potentially change the outlook, the trend in the S&P 500. But also to note, if the dollar is down like this, what is getting overbought conditions? And that's silver. So pay attention to silver. Silver has a strong correlation to miners. So the GDX, GDXJ. So if the dollar starts moving higher and silver takes a hit, it's highly likely to see potentially miners take a backseat too and consolidate their recent gains. As we've seen, this looks like a good time to be a part of gold and a part of miners, but you also want to be pretty strategic on how you trade around a core asset allocation, because you don't want to just chase it up into these areas. If you looked at a chart of silver right now, it's like straight up, right? And if you just bought it there and it starts consolidating for 2 weeks, 3 weeks, you might just be stuck in a position, your capital's stuck. So it's just a way to be a little bit more tactical. That's all I got for you on today's episode, everybody. Hope it helped out. See ya later.